You know, whenever I picture a business being sold, maybe it's because I watch too many movies, I always imagine this very specific scene. You know, the one, two guys in suits, a mahogany table, and a literal briefcase snapping open to reveal stacks of cash. Handshakes, cigars, done deal.
That is a fantastic image. It's cinematic, it's dramatic, and in the real world of Main Street business transactions, specifically places like Stark County, it is almost entirely fiction.
So, no briefcases full of unmarked bills?
Sadly, no. In fact, if someone walks into a business broker's office with a briefcase full of cash, you should probably call the authorities, not a lawyer. But seriously, that myth, the idea of the all-cash buyer, is probably the single biggest hurdle sellers face when they decide to exit. They think, I built this, I want my money, I'm out. But the reality of how deals actually get structured, it's messy, it's creative, and honestly, it's fascinating.
It's interesting you call it messy, because from the outside, buying a business seems like a math problem. Revenue minus expenses equals profit, multiply that by some number, write a check. Why isn't it that simple?
Because a business isn't a static asset like a gold bar. It's a living, breathing organism. It has employees, customer relationships, market fluctuations. If I buy your manufacturing plant in Canton today and tomorrow all the key staff quit, what did I actually buy? I bought a building with some expensive paperweights inside.
Right, the value is in the momentum.
Exactly. And that uncertainty is why the all-cash deal is a unicorn. Banks know this, buyers know this, and eventually sellers have to learn this. We need to talk about the gap, that massive canyon between what a seller thinks their life's work is worth and what a buyer and their bank can actually pay.
So let's walk through that. I'm a seller in Stark County. I want $1 million for my HVAC company. A buyer comes along, they want it. Why don't they just go to the bank, get $1 million loan, and pay me?
Because the bank is the most risk-averse person in the room. They look at that $1 million price tag and say, okay, we'll lend 70% or 80%. But they will only do that if the numbers are rock solid. And even then, they usually demand that the seller stays involved financially.
Wait, involved financially? I'm selling the business to get out. Why would I leave my money in?
This is the crux of the seller note. It's the tool that actually gets deals done in the real world. Think of it as skin in the game. If you tell me your business is solid, profitable, and future-proof, but you demand 100% cash the second you walk out the door, that signals to me and to the bank that you don't actually believe in the future of that business. You're grabbing the parachute and jumping.
That's a powerful psychological shift. So a seller note is basically me, the seller, acting as the bank.
Precisely. You are carrying a note. You're saying to the buyer, I trust this business will succeed so much that I'm willing to let you pay me the last 10% or 20% over the next 5 years with interest.
With interest?
Oh, absolutely. It's a loan, and usually at a decent rate. But more importantly, it signals confidence. When a bank sees a seller carrying a note, they relax. They think, okay, the previous owner is still on the hook. They're going to make sure the transition goes smoothly. They aren't going to let this ship sink because they're still waiting on their checks.
It aligns the incentives.
It forces a partnership. And in a tight-knit community like Stark County, that matters. We aren't talking about Wall Street hostile takeovers here. We are talking about local legacies. If you sell your business and it collapses 6 months later, your reputation in town takes a hit. The seller note structures that moral obligation into a financial one.
Okay, but let's play devil's advocate. I'm the seller. I've worked for 30 years. I'm tired. I don't want to worry about whether the new guy is running the company into the ground. Isn't carrying a note risky for me?
It is. There is risk. If the buyer goes bankrupt, you're second in line behind the bank. You could lose that portion of the sale. But here is the hard truth. Without taking that risk, you might not sell the business at all. Or you'll have to sell it for a significantly lower price to someone who does have all the cash, usually a low-balling investment firm that just wants your assets.
So you're paying for the highest possible valuation with a little bit of patience and risk.
Exactly. It's the price of a premium exit. But it goes beyond just seller notes. We're seeing more creative structures now, especially when the economy gets weird or interest rates spike. Have you heard of an earn-out?
I have, but it sounds like corporate jargon. Break it down for us.
An earn-out is the bridge for the optimists. Let's say you think your business is about to explode in growth next year. You want to be paid for that future growth. I, the buyer, am skeptical. I say, I'll pay for what you've done, not what you might do.
The classic standoff.
Right. So we structure an earn-out, we agree on a base price, and then we say, if the company hits X million in revenue next year, I pay you an extra bonus. It's contingent on performance.
That sounds great on paper, but doesn't that create a lot of friction? What if the new owner changes the strategy and misses the target on purpose?
You hit the nail on the head. Earnouts are notoriously difficult to litigate and manage. They require a tremendous amount of trust. If I'm the seller, I no longer control the steering wheel, but my payout depends on where the car goes. It can get ugly. But again, sometimes it's the only way to bridge a valuation gap. If you want top dollar, you have to be creative.
It seems like the recurring theme here is flexibility. The rigid seller, the my way or the highway type, probably isn't closing the deal.
They sit on the market for years, literally years, and eventually the business starts to decline because they've mentally checked out. It's a tragedy I see all the time. They hold out for the perfect, magical all-cash deal and end up with a declining asset that nobody wants.
That's a sobering thought. It's almost like the business has a shelf life once the owner decides to sell emotionally.
It does. Energy is finite.
I want to zoom out a bit. We're talking about structures, notes, cash, earnouts. But what does this say about the local economy when we see these types of deals happening in Stark County? What does it tell us about the health of the business community?
That's a great question. It tells us that the market is sophisticated, but it's also relational. These deal structures, seller notes, creative financing, they don't work in a vacuum of anonymity. They require relationships. The fact that these deals get done means there is a fundamental layer of trust in the local economy. A banker in Canton looks at a deal differently than an algorithm in New York. They look at the people.
So the creative deal structure is actually a proxy for human connection?
In many ways, yes. It's admitting that a spreadsheet can't capture everything. A seller note is a handshake made of paper and ink. It says, I'm betting on you to continue my legacy.
Which is terrifying and beautiful at the same time.
Business always is. And there's another angle here regarding the buyers. We aren't just seeing other local companies buying each other. We're seeing individuals, people leaving corporate jobs, wanting to buy a piece of the American dream in Ohio. These people need these creative structures. They don't have millions in liquidity, they have drive, they have skills, and they have a down payment. The seller note allows the transfer of wealth from one generation to the next. Without it, the market freezes.
That's a really profound way to look at it. It's not just a transaction technique, it's a mechanism for generational turnover.
Absolutely. If we demanded 100% cash for every business transfer, the only people buying businesses would be private equity giants. Main Street would disappear. These messy structures keep local ownership alive.
So for anyone listening who is thinking about selling their business in the next year or two, what is the one thing they need to get comfortable with right now?
Get comfortable with being a partner, not just a vendor. You aren't selling a used car on Craigslist, you are transitioning a legacy. Be prepared to show the bank and the buyer that you believe in what you built enough to wait for some of the money. If you can shift your mindset from cashing out to transitioning ownership, the deal will happen. And honestly, you'll probably end up with more money in the long run because of the interest on that note.
A little patience pays dividends.
Quite literally.
It's funny, we started this conversation talking about briefcases of cash, which sounds exciting. But I think the reality you've described, this complex dance of trust, risk, and shared future, is actually much more compelling. It makes the economy feel human.
It is human. It's arguably the most human part of capitalism. It's two people looking each other in the eye and agreeing to build a future together, even as one of them steps away.
That's a perfect place to leave it. It's not just about the numbers, it's about the narrative you're writing for your business after you're gone.
Couldn't have said it better myself.
Thanks for breaking down the walls of the deal room for us today. And for everyone listening, maybe take a look at your own business, not just at the P&L statement, but at the trust you've built. That might be your most valuable currency when it's time to sell. We'll catch you on the next one.